me to answer.
I've been getting all my people mixed up today, and
I'll
my
be
director
Craig.
tells me, Adrian.
So let me answer for Craig. I think expenses are critical. In fact, we were discussing this just before the show. Expenses are a pivotal part of a total return. And if you have excessive charge or egregious charge, this can do serious damage to your terminal wealth. So I think you want to be very mindful of the way of the level of fees, the way in which they charge. I think this opens a whole new can of worms. Does performance fee actually cause your manager to act better, to behave differently? Personally, I'm not convinced of that argument. I would argue against performance fees.
I'm probably shooting my own industry in the foot here, but we've got to a point in South Africa. I was chatting with somebody yesterday about it, that media itself is feeding. It's basically attacking the industry that it's found, financial media, in terms of we want like short-term sound bites for specific. We want somebody to give us a comment on whether Grindrod's going to $30 or $20 or whatever it is. We want very short-term thinking from that regard. But we don't have an appreciation of what a lot of the people are saying when they talk about their strategies. And we could use the example of Investec with the gold, with their gold strategy in the value.
Sure.
There doesn't seem to be an appreciation from the, and this puts you guys on the spot from some perspectives, because you may have the idea, you may have an investment idea that you understand, but are not being able to communicate it effectively to the market. If your clients are listening, somebody's put money into your fund and hears you on a radio show, does it worry you that they are not necessarily understanding, you're not having the opportunity to get the full message across?
Yeah, to me this flags a really important point, and that is, are we trying to convey news or are we trying to convey knowledge? And if whether it's an investment manager or a client or a desk like this that is very near-term focused, here I can only speak my own book. It would work, to my mind, it would work against a client, and it would work against value. Value doesn't have a monopoly on producing alpha, but in South Africa, value has a long record of producing 4% better than market per annum. And if you go to deep value, which is where I reside, over a 10-year period, 8% better than market. The only way that you can get that 8% better than market per annum is by being patient, by taking very long views, and being willing to walk the dark yards, because as Craig flags, it's in emotional periods that people want to throw up their hands and say, well, hang on, you've lagged the market. It's not that we've lost money, but you've lagged the market. I'm going to go and join the crowd. That's much more emotionally comfortable. You can only get this excess result by being in a minority. And that is where I think value is really in its power. And value, by definition, requires longer horizons.
So how do you help clients to sit through those dark times and to take the long-term view? How do you go through that?
Well, I'd like to think that we come on shows like this and remind them of. If you gave me magic fairy dust and I could put a single ingredient into any of my clients, it would be the wisdom of patience. And that patience would encourage discipline. What we like to think in this industry is that we know where the turning point is. I'm yet to find anyone who can tell you consistently that they know where turning points are. And if you don't know where turning points are, then the next best and very powerful element that you have is the discipline of staying the course.
I think Pete Fulton actually tweeted a link to a very interesting article that Warren Buffett wrote back in 1984 for the business school where he graduated. And he used a very good analogy, and I thought it was, I've heard the value argument from different things, but essentially what he says is when you build a bridge, it can hold 30,000 tons of traffic over at any point, but you don't want to be sitting there trying to test the 30,000. You want to be able to build a bridge that typically deals with 10,000 tons going over it. How do you convey that idea of safety in a value manager strategy? Because the idea effectively is you don't overpay for something, you don't chase momentum when it's there. How do you, it's essentially a strategy that says I'm going to not lose money during these periods.
Again, I think it depends what type of value you are. So if you are a long-only value manager, then it would probably be misleading to suggest that you're never going to lose money. I don't think it would be misleading to say that you've built very defensive portfolios. And if you look at Cannon's portfolios right now, for instance, where, as Craig and I were discussing, our perception is that the market at the moment looks pretty stretched. And where you have stretched markets, you actually have high risk of capital loss. I think that that's where we are in the South African environment right now. When you look into Cannon's portfolios, what you see is a raft of single-digit or low double-digit price earnings companies paying high dividend yields, strong balance sheets. There's no confusion between accounting earnings and cash flow earnings. It's cash flow earnings. And I think that this is the essence of successful investing, is paying a good price for good businesses, and now we must wait. And we're waiting.
And Craig, over what period should Adrian be judged in terms of his in terms of the skill that he brings to the party? Because I think you obviously markets are cyclical. We're having a run at the moment. What's a fair period in which to be judged?
So I would say the minimum would have to be at least 5 years, because equity is you're buying shares and stakes in businesses, and businesses are implementing strategies, and those strategies take years to unfold. And at times it takes the market even longer to recognize the value and the sustainability of the earnings that's going to come from the new strategies and that. So typically a minimum of 5 years, but the longer the better. And you're not only looking at performance, you must look at risk adjusted as well, because we have this single focus on who outperformed, but if they've taken unnecessary risk to get that, then it's like driving at 140 when 120 will get you there in time.
Adrian, I mean, turning around, what period do you want to be judged over?
I forget who it was who said, the ideal mandate is forever. Because what you can do then is you can take really patient and really patient decisions. If you're looking at 3 and 5 years, the last 3 and 5 years won't shine a warm light on any value manager in South Africa. It's been a very lonely place to be, to the extent that many people who used to describe themselves as value are now somewhere else. And I think that whilst returns are one thing to look at, I would actually preface that and say that your due diligence should be on philosophy and process also. Is the philosophy consistent? Do I understand what this manager is doing? Do I agree? Does it sit comfortably with me? And are they consistent in their process? The rest will come. And going back to Pete, he tweeted earlier this week a lovely observation. He said, in the late 90s, there was this frustration that value was dead. And of course, it wasn't. The most dangerous words in investing is this time is different. This time is no different. It's a long value drought. It's not different. I
just want to put you on the spot just for one quick last moment. The same argument's been put with long-term capital management. The guys still, even after they blew up their business, they still said we were right. How do you respond to that kind of counter-argument?
Look, I think it's a fair question, but long-term capital management is a dramatically different business to building a deep value or contrarian strategy. Long-term capital management was, 60 times geared, and you needed to be just a tiny bit wrong, and you had blown up all of the capital. So the way that we're describing value here is in a rather dull light. Value hasn't lost money in the last 5 years. It's lagged the market. You would have to do something spectacularly stupid to destroy capital in the same way that long-term capital management did.
And on that point, I think we'll have to wrap this part of our conversation. Of course, some profound statements made around philosophy, process, and returns. Of course, that was Adrian Saville, CIO of Cannon Asset Managers, and Craig Graduate, financial planner at Graduate Mahura Investments. Time now for Befriend the Trend. In the age of digital, who would have ever thought that music consumption will return to its roots? Well, it's happening. Vinyl is making an unlikely comeback. LP record sales in the US increased 32% in 2013, while CD and digital sales took a thump. Now, Marc, I know this is probably something that was quite famous back in your day, before the rest of us were born, but Why is vinyl coming back? Why the sudden, appetite for LPs? I thought iTunes was the way to go.
Hey, I did disclose in the magazine this week that the first tape I ever bought was Vanilla Ice. So let's be honest.
Wow.
I mean, I think this is fascinating. Whether it's a real trend that somebody will be able to cash in on are still up in the air, because but I do find it fascinating that CDs are very rapidly going out of fashion in terms of as a music medium, and vinyl's coming back. This very much, it goes back to this thing that we're seeing with the craft brewing, the home winemaking. There's this idea of actually going back to some of the really traditional items that are out there, and actually going back and embracing things that were really, technology changes so fast, but being able to go back to these things that you can manage yourself and have a genuine appreciation of what went into it. There does seem to be this whole culture coming back.
But would you have to have collector's items, like the very originals, for you to be able to cash in on this particular trend? Yeah,
look, I think we've featured one of the store owners who says he's actually doing booming business in Cape Town. It's never been better, which is amazing. But I think that it's a lot like stamp collecting, in that a stamp is worth something, but it's only worth what somebody's ultimately going to pay for it. So I think that it is one of those, the appreciation is not necessarily a rand or monetary value. It's the appreciation of being able to join into a community, being able to exchange some of these vinyls, and appreciating what went into it.
Yes, as we move more and more into a digitally driven environments, personally and professionally, there's definitely a nostalgia for things that remind us of our past, even if it wasn't part of, say, my past, as part of generation whatever I am, X or Y. We like to see black and white photographs, we like to see and it just reminds us of something that perhaps we don't understand, but we want to go back to and experience.
So it sounds like as if while we're hurtling into the future at a very fast pace, we're also trying to backtrack and hold on to the past as much as possible. But we're going to take a short break now, and we're going to see you right after this. Welcome back to Finweek Money Matters. Now, while a long beach holiday in the Maldives may be the only thing you want to spend your money on once you have sold your business, it's also important to cleverly and strategically invest your new wealth cash pile. Joining us for this conversation is Ricky Williams. He's a portfolio manager at Anfield Investment Planning, and Lionel Kopp, CFP at Chartered Wealth Solutions. Gentlemen, thank you so much for joining us. Now, in an earlier session, we had a businessman whose business had recently been acquired. So I made the assumption that he had a big pile of cash that I've just referred to, but it doesn't always seem, seem to be that way. And maybe I want to come to you, Ricky, Lionel, Lionel, with this particular question. Once a businessman or business lady sells their business, is it always a good idea to reinvest and start another business, or should you perhaps think of investing in your existing business before you even sell?
Well, it goes a little bit, you need to go back a little bit further than that, just before the decision in terms of what you want to sell. But let's take the example that you spoke about, whereby a person has sold their business. One of the things that we find in our practice particularly is that when you deal with people and it comes to large sums of money, the important factor is that you need to know where they are and where they're going. So what we would suggest in order to answer the question is we would divide the assets into three different distinct types. The first one would be lifestyle assets, and that would be related basically to where they live, their home, or their holiday home, or their timeshare, or any place, or any asset related to what they call as their lifestyle, including their cars and that kind of issue. The next is retirement assets. Now, those are the assets that's going to produce the income in order for them to eat well and sleep well in retirement. And the third one is surplus. So the surplus is the type of money that you can already give away to charity, you could give to your children, you didn't have to die. So in fact, if they didn't have that money, they can still live within the boundaries. So the first part of the answer would be is to make sure that there are the three distinct issues, and then from there are many questions one needs to ask as to how they're going to deal with the money.
Ricky, I mean, maybe I'll throw this question to you because I'm intrigued by it. Do I take a lump sum or do I give myself staggered payments? I know my own personality, and my own personality says that I get a chunk of money, I'm probably going to go and spend it, and I'm probably going to go and take, all I'm saying to do is take bigger bets on where the Stormers are going to win the rugby and that kind of thing. I don't have the self-discipline to be able to go and manage that money. Do I take it in staggered payments? Do I just take one big lump sum? How do I plan that? And more importantly, do I go and put it into some kind of trust structure, business structure? What are the logistics there?
Mark, there are a number of questions lumped together there.
Yeah.
I'm going to refer back to what Lionel said, and I think that everybody's different, just to start with.
Mm-hmm.
Everybody wants something different. Personalities are different. Skill levels when it comes to handling money and understanding money are totally different. And each of those individuals, it's important to treat them at their level. But there are generic issues. We operate very closely on the same basis as Lionel's practice would, understanding that the reality of the person's situation is that they have set requirements, and those need financing. So to see to those things is where the questions come into it, and the individuality comes out. So a person like yourself, probably, not to be unkind, would be better handing your situation over, before I say handing your money over, but certainly to hand your situation over to somebody who's highly skilled and proficient, very experienced in advising people in your situation. I can tell you that I have been involved in many of these situations before, as Lionel. It is quite common practice for that individual to buy himself a present, a success present. And the Aston Martins and Porsche Turbos come out, and dripping with diamonds, wife, and which is nothing wrong with that. So it's part of the lifestyle, as Lionel said, and that's what they want. They deserve it. They can afford it. And then typically those people sit down with you afterwards and are very demanding in terms of making sure that they are not going to run out of money. They're all terrified that when they look ahead, how many years they still intend living and how many months of income they're going to need. And they don't have a job. So it's quite a terrifying situation, and every individual handles that differently.
Lionel, is there a magic ratio that one should seek to get into place when you make the differentiation between lifestyle, retirement and surplus?
Yes, well, the question is always, and if somebody would give me the answer, how much is enough? And one must also be very respectful. Ricky made a very good point as to each person is an individual, each person has just needs, wants. So the question really is as follows. The normal rule would be is that one, in terms of income, to help answer Mark's question, if he did in fact want just the income rather than a lump sum, would be 20 times your monthly, your annual income. So that if you had 20 times that amount, based on inflation around about 6%, which we're not sure where that's going to go, but that's sort of a guideline. But the issue really is more to be respectful to the client and to ask the questions in order to find out what is it that the client really needs and what the client really wants. There are books written by George Kinder, The 7 Stages of Money Maturity. There's a book by Mitch Anthony, New Retailer Mentality. Now, in these books, that's exactly what you will find, the answers to these questions. And if you go through these processes of being from a child to an adult to reaching your aloha, which is the time when you want to really retire, and you can do it at a young age, an old age, once you've reached that factor, that will answer the question, what does this man do with his money? And I also must say that you will find a successful businessman will find it very difficult to give you his money to invest when he's done so well himself. And that's the respect that you have to understand, is that he can't have all the eggs in his basket, and the diversification is the secret.
What are some of the challenges that you think are unique to people who live in Joburg as opposed to people who maybe live in Cape Town? I mean, Joburgers are known to be very flash, and we like our cars. And so what do you think are the unique characteristics?
The Cape Towns, as the Cape Townians say, they say, well, we got the mountain, and we in Joburg say, well, we got the money. So what do you want to have, the money or the mountain? But I think that that's a very, very good point too. The lifestyle that they live in Cape Town seems to be far more laid back. And the name Slaapstad as opposed to Kaapstad could in fact come into the equation. But I think that's another issue, is that if you've lived in Joburg your whole life and then you're going to retire in the Cape or into one of these little tiny places, you've got a mental issue there too, because you want to be going to the things and do the things you want to do.
Ricky, I mean, we talk about this, the respect between the financial advisor and the client. But the financial advisor has to be quite tough in this environment. It's not like taking an ordinary sum of a month-to-month sum of money. This is a big chunk of money, and the moment somebody says that they've got 20 million from selling a business, the vultures are going to circle it, and it could be wives, children, etc. It's the bank. You're going to have this environment where this is suddenly a pot of gold, and it's not just one person's life that's impacted. They see, a lot of people will see it. How do you deal with that? Because it's often, it puts you in direct conflict with a lot of the surrounding partners.
Yeah, it's hell of a well spotted. One needs to have eloquent solutions.
Mm-hmm.
You need to have the ammunition to combat the opposition. So either you've got that or you don't.
Mm.
The person at that level is erudite enough to see you coming one way or the other. So he's had guys his whole life phoning him out the blue, 10 Liberty Life agents calling him a week. So he's very experienced when it comes to that, to the point of being cynical, some of them. So you have to know your P's and Q's. That experience is absolutely vital, and then the team that you work with must be masters each in their individual discipline, and to be able to deliver eloquent solutions.
Just a quick one. What are some of the most unusual things that you've seen people, like the newly wealthy, do with their money? Are there some crazy things, like maybe buying a racehorse here and there?
From my side, a lot of them have bought into game farms.
Okay.
They really found that the first is the biggest 4x4 by far you can get. That's the most one. I'm sure Ricky will agree with me on that one. Thereafter, the game farm, then you value the different kinds of the buck that you have to get. So I think that would be the most extravagant, in terms of whether there's value there or not. Or the other one is always a second kind of a home or a second.
Jessica, my part of answering that question would be that what I've found people tend to want to become what they always dreamed of being, and never turned out that way for them. And you see guys going into quite odd businesses and hobbies that the last thing you would ever imagine, the guy never mentioned it before. All of a sudden, he's got a workshop full of woodworking equipment, and he's there till 3 o'clock in the morning.
Yeah.
So I've seen lots of examples like that. It's interesting.
Unfortunately, that's all we have time for this week's edition of Finweek Money Matters. Thanks again to our guests, Ricky Williams, Portfolio Manager at Anfield Investment Planning, and Lionel Kopp, CFP at Chartered Wealth Solutions. Remember that you can read more about these stories and many others in this week's edition of Finweek on shelves from today. The magazine is also available digitally in English and Afrikaans via mysubs.co.za. Thanks again to my co-host, Finweek editor Marc Ashton, and journalist Jessica Hubbard. And we'll see you again, same time next week, and hope that you've had a good start to the year.